Hi, welcome to another session with Tiger Life, and I'm Alvin, CEO of Dr. Wealth. So today I'm here to share with you investing trends in 2023 and how you can use some of the ETFs to express the investing trend. I also will explain to you why ETFs are one of the better ways to invest in trends rather than individual stocks. As I mentioned, I'm Alvin, CEO of Dr. Wealth. I invested in stock market for over 15 years. You might see me in some of the media appearances, right? So I just did one for Money Mind for the next 2 weeks feature. So you want to learn more about value investing, you can catch the program over there as well. So these are the 4 trends for this year and actually and beyond, okay? Because some of these themes may run for more than a year. For example, the first two, embracing ESG, which stands for environmental, social, and governance kind of factors. And second is the EV transition, right? So these two trends are going to be around for maybe the next 10 or 20 years or so, right? So it's not just for this year alone. Whereas for point number 3 and 4, trends number 3 and 4, these are the shorter term trends. Okay, so we're talking about potential Fed pivot. That means the Federal Reserve may not raise interest rate that high, or they may even stop raising interest rate given the situation in US, the Silicon Valley Bank failures, and I'll give you my view what I think about it. As well as last trend is the weakening dollar. We are already seeing some signs, right? It's also related to what is happening in the US with regards to the bank failure. So definitely trend 1 and 2 are the longer term ones, and trend 3 and 4 are the shorter term ones. Okay, so let's begin with the explanation of why ETFs are the best way to invest in trends. The way that I see it is because, yes, you might see a particular sector is very interesting, very sexy, you think that's the future, and you may want to bet on it. So maybe, for example, you might be interested in electric vehicle, and you like Tesla as a company. Nothing wrong with the company, right? Just that, of course, it is difficult to predict whether Tesla can maintain its market share and its growth rate going forward in the next 10, 20 years. It's going to be very competitive. In fact, BYD has already taken the first place in terms of market share, right? In terms of in terms of number of vehicles sold, right? So there may be more competitors coming that can either oust both of them away, right? Or for all we know, Tesla may not grow as fast as what it has in the past. So in that sense, that maybe you're very bullish about the EV sector, but you just don't know which company will become an ultimate winner in the end. So the safer way is to bet the entire sector, right? Buy an ETF that invests in the biggest EV companies at the current moment. And the good thing is that the ETFs will adjust by itself, right? Because the index will adjust the components, the weightage. If there is a new winner coming in, and then the incumbents get faded out, the index will make that change, and automatically your portfolio is being balanced and managed from that angle. So that's why you pay a management fee. You don't need to take care of the nitty-gritty details, the buy and sells of the companies, and the index takes care of everything, right? So that is why I think that the ETF is very suitable in investing in any trends that you want, because there are already a lot of ETFs available. Whatever trends, whatever sectors you want to bet on, there is, I believe, one or even more ETFs that can give you the option to do so. Okay, and the second point that I want to mention is the volatility is tend to be lower because you're buying a basket of companies rather than just one stock or two stocks, right? It's definitely going to be more manageable with the price fluctuation as compared to the individual stock, right? So that is what I think ETFs are the best for trends, for future trends, okay, to invest in them. So the first trend, let's go into it. And it's highly related to more towards the environmental side, right? Because ESG technically is more than environmental. You're talking about social, talking about governance, corporate governance, all this kind of thing. But I would think that the key feature of that ESG, or the main focus of it, is still going to be more related to environmental, right? Because we all have been hearing about climate change. We have all experienced it one way or another. And I think that it's not going away, and we will try to understand why, right? So the very first thing is that we all understand global warming is happening. The temperature is rising on the surface of Earth. We may not feel it from year to year, but if you zoom out, this is like a 200-year, 100-year chart. Okay, you can see that the surface temperature has climbed about 2 degrees Celsius, okay, from say 100 years ago, right? Or we can even shorten it to like maybe 70 years ago, okay, in 1950, we already started to see that the temperature started to climb. And that's largely due to the burning of fossil fuel, the industrialization that happens in the 1800s. So when we burn more fossil fuel, contribute more the carbon dioxide into the atmosphere, they trap heat from the sun instead of repelling them back to the space. So that's why the global surface has been rising. Surface temperature has been rising, plus 2 degrees Celsius. Or actually, it's not degrees Celsius, 2 Fahrenheit. Okay, so it's about 1 plus degrees Celsius. Okay. Still, it is not desirable, right? Because it will bring about other effects, which I will share in a bit. So fossil fuels is the major contributor of carbon dioxide. And you can see coal, oil, and gas, right? So these are the main culprits. The land use is pretty constant, as you can see over the years. Just want to go back to this chart again. You can see that the natural causes of carbon dioxide, temperature rising is insignificant, right? It's flat. But it is really the human driver that has caused the temperature to go up. So it is due to this, this correlates with the rising use of fossil fuel. Okay, so that is what we can conclude. And these are the climate change effects, just some of them. There are actually a lot more, but we started to see more of the extreme temperatures happening, right? Of course, many places are not that serious yet, right? We haven't seen like droughts, we haven't seen like desertification, we haven't, but we have seen tidal flooding, right? Those low-lying areas like Venice, okay, so they did experience some of the tidal flooding. And we also see the heat wave that happened in Europe, China, and other parts of the world, right? It's getting more and more frequent. Okay, so I would say that these are not trivial things to to think about, right? They can get worsened, okay, because we are still very reliant on burning the fossil fuel. And of course, understanding that that is the trend is not enough. We have to see that the governments around the world are very committed to this environmental kind of emission, right? Carbon emission. And indeed, most of the countries have pledged carbon neutrality. And most of them are aiming a target of around 2050 to reach carbon neutral. That means that, yes, we'll still produce carbon in the atmosphere, but we also will be able to capture the same amount, remove them at the same amount from the atmosphere, right? So it becomes like really neutralized, okay? So it's totally impossible to emit zero carbon dioxide. Okay, even nature emits carbon dioxide, right? So it's about reducing the emission and increasing ways of capturing this carbon from the air. Okay, so with all this commitment, that means there'll be policy, there'll be plans, there'll be resources directed to these environmental protection measures. And that would also mean that companies that are more environmentally friendly or that they are dealing with this kind of a clean energy, or they are helping to remove undesirable gases like carbon dioxide from the air, these companies will benefit, right? This company will get more attention, this company will get more businesses. Okay, so that is what, from an investor perspective, we are interested to look at. And one such ETF we can consider is this Lion-OCBC Securities Singapore Low Carbon ETF. It has two ticker. One is ESG, one is ESU. One is in Sing dollar. One is denominated in US dollar. So you can choose your preferred currency. And I just want to give you that picture, right? So the index that they were using is this OCBC Singapore Low Carbon Index. There's 50 stocks in them. And then there's this MSCI Singapore Index, which is also, I think, about 50 or 60 companies. And then there's Straits Times Index, this is only 30 companies. Okay, so this is compared against their carbon intensity. Okay, so you can see that the low carbon index relatively is lower in terms of the carbon emission compared to the other indices. So if you are an investor who cares about the environment and you think that this is going to be a big thing and not just playing a part, but also can benefit from it financially, this is some of the ETFs you can consider, right? The more ESG focused ones. And one example is this Lion-OCBC Securities Singapore Low Carbon ETF. And these are just some constituents, the top 10 ones, just to give you a flavor what kind of companies we are talking about. And we can't go away with that three local banks, right? Because in Singapore, the largest companies are the banks, and they do command a very big presence in the overall economy, and it's also reflected in their market cap in the stock market. Okay, so you can see that the majority are still the top three banks, but naturally speaking, banking do not really produce a lot of carbon, right? Except for probably the energy that they use and the humans that are emitting it. Other than that, it's not like manufacturing companies where production will cause a major generation of carbon dioxide, okay, because more energy is being used, right? So if it's normal office work, I don't think it contributes much energy, consume much energy or produce much carbon dioxide. So that's why I think the three banks are in it. And we also have tech companies like C and Grab. Again, tech companies are more service oriented. They are not so much on that hard product manufacturing, right? So that's why I think that this index is interesting because it does include some of the overseas listing like C and Grab that are listed in the US, but they're still based in Singapore, right? So we think that this, or I think that this index is more encompassing than compared to Straits Times Index, where Straits Times Index do not have that these tech companies, right? So it looks more comprehensive in that sense. Okay, the next trend, the second trend is electric vehicle. Okay, so I think increasingly more and more people are going to buy electric vehicles, and this is a trend not just in one particular country. It's evident in almost all the countries. I would say at least the developed countries. Okay, and this is the global sales, and I just want to give you explain some jargons. So BEV stands for battery electric vehicles. PHEV stands for plug-in hybrids. Okay, so if you really want to talk about EV, pure EVs is the battery electric vehicle. These are 100% powered by electricity batteries. There's no internal combustion engine in it. Whereas the hybrid, it is part electric, part internal combustion engine or ICE. Okay, so if you're a purist, then you just look at the green parts. Okay, regardless which part you see, you can see that the EV numbers are really rising in terms of vehicle counts. Okay, this is a sales per year in terms of thousand. So in 2022, there was more than 10 million. Okay, more than 10 million electric vehicles sold around the world. And this red line is the electric vehicle market share against the conventional vehicles that are powered by either the petrol engines or the diesel engines. Okay, so it has climbed to 13%, and you can see that it's very consistent. Every year, the share of the sale has increased for the electric vehicle. That is why I say that more people are buying electric vehicles than the conventional types of cars or trucks or commercial vehicles. Okay, and you can see the growth rate 55%, 70% year on year. These are yearly growth rate, right? So the numbers are generally very high in 50% range per year. So if they can grow at this pace, we can really see that the electric vehicle would make up the half of the total sales of vehicles around the world. Okay, so this is the trend that I don't think is going back anymore, and this is a permanent trend. And China, of course, is the most important market for electric vehicles because they are the largest in the world in terms of number of sales, and the growth is also one of the highest, right? So we can see this is Europe, this is China, this is North America. Right? We just need to focus in these three regions. So Europe has about 2.6 million sales in terms of vehicle, and it has grew 15% from 2021 to 2022. Okay, this is 2021, gray one is 2021, and blue one is 2022. And if you look at China, it last in 2021, it has a 3.4 million, then it almost doubled to 6.2 million in a year. So that was an 82% growth, right? And in North America, it was 748,000 cars, and then to 1.1 million, that was a 48% growth. Okay. Even though the number for other parts of the world is smaller, but the jump in the overall market share, total market is actually the biggest. Okay, so it's claiming more, right? But in terms of the growth rate, you can see that the biggest market in China is now way ahead. Okay, at $6 million. It dwarfs almost everything. If you add up vehicles, EVs in the rest of the world, in terms of sales, it is still lower than what is in China sales alone. So China is indeed the biggest and the most important EV market in the world. And that's why there's this suitable ETF that invests mainly in the China EV and as well as the other products like batteries. Okay, so this Nikko AMSTC, MSCI China EV and Future Mobility ETF is the one that we're talking about. So they also have two counter, right? One is in Sing, one is in US dollar. And some of the well-known companies like this Contemporary Amperex Technology, or CATL in short, is the world's largest electric vehicle battery maker. It has quite a big weightage in the index, is 11%. Okay, so the funny thing is that the number one spot is not an EV company, it's actually an EV battery maker. But it's not surprising because this EV battery maker sells the EV battery to many brands, not just one company, right? Even Tesla, it supplies to them. So naturally, it is a bigger company compared to many of the other EV brands. Then, of course, there's BYD, that's the world's largest EV brand. They also make batteries, so they're quite vertically integrated. Okay, so that is in terms of number of cars sold. Okay, but BYD also sell a lot of hybrids. Okay, they are not just purely EVs. They do have, but the hybrids are counted as part of their sales. That's why the numbers looks a lot bigger. Then there's also another company worth mentioning is this Longji. And they actually are more specialists in solar panels and also making that silicon raw material for the semiconductor industry, right? So, but they make use of their ability to extend that service to produce those solar powered EV charging station, right? So they make use of the solar panels. Okay, so instead of like, again, you burn fossil fuel, then you charge the batteries using the electricity that was generated from fossil fuel, is still dirty, right? Just shifting the endpoint from the car to the power station. Maybe there's some economies of scale, so the overall emission is still lower. But this is even better, right? So you use solar powered EV charger and then you charge your electric vehicle. That would really tremendously reduce the emission, right? So you can find quite interesting companies that are in this ETF itself. Okay. Next, let's talk about the forecast, right? So even though 2023, it seems like the economy is slowing for most of the countries, but the sales forecast for EV in China is still healthy, right? Although not as high in the 80% gain, but still about 30% rise from the 6.4 million unit to 8.4 million unit this year. Okay, so if they are able to achieve this, I think that the EV growth is still on track, right? Despite the slowing growth in China. Okay, now come to the exciting bit. Now we are coming to the shorter term kind of trends, right? So one is that we understand that the banking crisis in the US is unfolding. We have seen like Silicon Valley Bank going under, Signature Bank going under, and both are rescued by the Federal Deposit Insurance Corp, FDIC, as well as the Federal Reserve has also come in to pledge some liquidity for the banking system. Okay, so this is worrying the market right now, right? Interest rate hike is no longer the focus. It's more of whether US can contain this banking crisis, right? Because it cannot spread to the rest of the banks. If enough banks are running into trouble, and that would mean that depositors, investors will lose a lot of confidence in the system, and that will cost more money to be withdrawn from the system and cause it to spiral down even more, because it become a vicious cycle, right? So that is why I think the government was very quick to arrest the issue, right? They will say that, okay, depositors, you get back most of your money, right? Don't worry about that. So that is in part trying to restore the confidence and preventing it from spreading further. And this is just to give you a quick understanding of what was going on, right? Just in case you didn't really follow the media, the news, okay? So I will take the Silicon Valley Bank as the example, right? Because they are the 16th largest bank in US. So which means for their size is worth talking about. So this SVB or Silicon Valley Bank, it's special in a sense they were focusing on lending to startups. Okay, most banks would shun the startups because the startups usually are smaller and their financial institution is really bad. Okay, some may not even have revenue, right? Or even they are running at big losses if they have revenue. And that's why banks generally don't like to take that risk and lend to startup. But this SVB is special. They are very generous to the startup. They focus on the startup, not in a sense of being a bad way, but they in fact play a very crucial role in developing the startups in the US. Okay, so what they usually do was that the startups, once they raise money, they will park in the bank, and then the SVB will, on top of that, lend them some money, right? So that actually increases the float and the runway for these startups. So that's why the startups love SVB a lot, and SVB got a lot of banking clients from the startups too. During the interest rate environment that was low, startups raised a lot of money because it was easy to raise money. The world was flush with cash. VCs have a lot of money. Angel investors have a lot of money. They are looking for companies to throw the money to. And there wasn't enough places to generate high returns, right? Especially not in the fixed income market when the interest rate is low. There's no point. And there's also no point staying in cash. So that's why money was chasing after investments, and startups found it very easy to raise the cash. And once they raise the cash, they deposit the money in SVB, right? Banks like SVB. So SVB suddenly is flooded with deposits. But they will run into the same problem, right? They need to find ways to earn money on their deposit. But because there's so much deposit, not enough borrowers, they were still sitting in a lot of surplus. And that made them chose one of the avenue was to invest in the US treasuries, right? Because they are deemed as the safest form of investment assets in the world, AAA rated, backed by the US government. So the banks like SVB invested a large amount in US treasuries, right? Because they are the most safest. They're the safest and the stable kind of assets. Okay, and nothing wrong with that, right? They're not taking blind risks. Okay, they're actually being very prudent. But something happened last year, 2022. The Federal Reserve hiked the rates, and because the bond price and the interest rate are of an opposite relationship, one goes up, the other goes down. So when interest rate goes up, the value of these US treasuries went down, and went down by a lot. So collectively, all the banks in the US, they are down like what, $600 billion in terms of the mark-to-market losses. Okay, so because 2022 was special in the sense that the Federal Reserve hiked the rates very fast, fastest in history. Okay, so nobody know what will break. And finally, now in hindsight, everybody know, right? Oh, okay, the banks cannot take it anymore. There's going to be a bank run. Okay, so that is one of the consequences of the Fed rate hikes. And now startups will still need to have the cash, right? They still need to withdraw the cash, and they need to pay the staff salary, they need to pay for expenses. And now particularly it's difficult to raise money. And if they don't raise money, which means that the deposit to SVB is not going to increase as much as before, right? And now SVB would need to cough up more cash to return the money to startups as they withdraw the cash, right? But the problem comes when the treasuries now is having losses. If they have to sell the treasuries, they will have to realize the losses, and the bank will have to absorb the hit. By right, their intention is to hold the treasuries until they mature. so that they will get back their principal, right? Because treasuries are usually 6 months to 1 year. It's very short, okay? But unknowingly, because the cash withdrawal is much faster than a deposit right now, given a higher interest rate environment, and that's where the bank started to realize, oh, I have to sell, right? I have to sell in order to raise cash to return the money to those who want to withdraw. So no choice, they did that, and until a point where they realized that, oh, I cannot stomach the losses anymore, and the Federal Reserve would need to come in, Federal FDIC would need to come in and save the bank, and that's what exactly happened. Okay, so now the problem is that it seems like the problem hasn't gone away. Okay, although most people feel that that is a good move that the government has came in and built out both the banks, but the fact that more bank stocks are crashing, right? More bank stocks are crashing. PacWest, First Republic is rumored to be the third bank that's going down. Even a very large bank like Charles Schwab was also down 24%, which is not very assuring. Okay, so with that, it seems like investors are expecting the more banks to fail. And how many more are the US government going to save? That is a question mark. Okay, so they have to keep saving and to keep restoring confidence in the financial system. Otherwise, it will be spiral out of control. It will be a disaster. Okay, this is almost like a repeat of 2008, just that it is of different reason. 2008, the banks were careless. The banks were aggressive in lending out to subprime borrowers that they couldn't return the money. But this time round is different. The banks didn't do risky stuff. In fact, they bought the safe stuff, which is the US treasuries. But because of the rate hikes, they also didn't see it coming. And now they are running on very deep paper losses. Okay, whether they can hold until maturity, that's another question, right? And it's not just about saving the banks, because as we talk about companies like banks like SVB, they support a lot of startups. And a report came out that there were some startups, quite well-known ones like Roku, had more than 20% of their cash in SVB. And if SVB collapse and Roku can't get back the cash, which means that they are in fact jeopardized, and they may even go bankrupt, and they may not even pay the staff, meet the staff payroll. And this is serious because there will be a lot of domino effect, cascading effect. You will see not just the bank fail, but many, many tech companies, tech startups fail as well. And it got nothing to do with their business. It is just a liquidity issue. Suddenly the cash that they have just go missing, right? So it is going to be a very big disaster if the confidence don't get restored. And this is the rumor that's spreading around, not say spreading, like it's actually in the public. Goldman Sachs actually think that the Federal Reserve may rethink whether to raise the rates. That's happening on 20th and 21st, right? Where the Federal Reserve will be meeting to discuss about the rate hikes. So given this situation, given this event, something has broke. Okay, something has broken. And that's why the Federal Reserve might be more maybe a wait and see attitude, right? Let's not raise rates this time round, and let's kick the ball down the road and see whether the situation still stabilize, right? Because if they still go and raise the rate in the 10 days time, the market is going to rock some more, right? More banks might fail. So I don't think they want that to happen. Okay, so personally, I also think that they are possibly going to pause the rate hike. Yeah, we're talking about pause. We're not talking about totally not hiking rates from now on. Right, probably pause for March since the event just happened, and maybe May they decide again whether they want to raise the rates. Right, so there's a high chance that this Fed pivot might happen earlier. So if that's the case, then bonds will have a good time, right? Because bonds, as we understand that they are inverse related to the interest rate. So if interest rate goes down, the bond prices go up. Okay? Yes, we are not talking about rate cuts at this moment, but there's already something happening in the markets right now. right? So later I'll give you a bit more explanation. But let's assess the risk reward ratio for bonds first. Okay, so of course you can look at bonds in US as well, but we just limit to the Singapore context. So there is this ABF Singapore Bond Index Fund, and it's one of the earliest ETFs out there listed in SGX, and it's all backed by AAA rated bonds by the Singapore government or quasi-government like stat boards like HDB, LTA, all these kind of agencies. And compared to the past, right, 8 years ago, it was the yield to maturity was just 2%. Now it's more than 3%. Last year, sorry, 2022. Right? So you can see that the yield has improved. Okay, you may say that, yeah, it's just a little bit of improvement, but considering that this is AAA rated bond in Singapore, this is not common, right? And some of the tenure average duration, I think, is about just 6 to 7 years. Okay, it's rather short, right? It has hit 3%. Even for CPF, it's 2.5%, right? This is higher than CPF. Okay, so and the ETF is also at 5-year low. And the thing is that the upside is more than the downside, right? Because if let's say the Federal Reserve really cut interest rate, right, you will get to lock in the higher yield. At the same time, you enjoy some capital gain. Okay, so that is why I think that not just me, a lot of analysts are talking about this year might be a good year to look at increasing the bond holdings because you may not be able to enjoy such high interest rate for the next few years. Okay, so you might want to lock in at rates at the moment. So this is what I mentioned already, right? Interest rate goes down, bond prices go up. So the other thing is that even without the banking crisis, right, the peak bond interest rate, yes, it's still rising a little bit from 5% to 5.2%, but it's hovering around that area. So which means that we are closer to the top. Okay, so let's say we assume it's 5.5%, it's the peak interest rate, and now we are about 5%. Okay, so it's there, right? Compared to in the past, it's 0%. So definitely we are closer to the top than the bottom, which means that even if they hike the rates, it's not going to be very aggressive. It's not going to be a lot. So which means the bond prices going down is just smaller, right? But you can lock in at a higher yield already. And if they cut rates, you're going to enjoy a much bigger capital gain. Okay, so the risk is here, the reward is here. Okay, so the risk reward is a bit lopsided, and that's why it makes a good trade. Okay, so I hope you understand that. And this is what happened, right? In fact, the yield was around 5 point. This is 1 year treasury in the US. Okay, because of the renewed Federal Reserve rate hike expectation, it went to 5.25%. Then suddenly, when the banking crisis happened, it dropped below. Now it's 4.9%. Okay, in just a few days, right? This is a very big drop. Okay, and caused the bond prices to spike as well. So you can see that the trend has already reversed, right? So either way, whether the Federal Reserve don't raise rates that fast, or they cut rates, or the banking crisis continue, okay, it is all favorable for the bonds, right? That is why I think that with this event happening, this banking crisis has caused the bonds to be even more attractive than even before the crisis happened. Okay. Then the last trend is related to the US dollar. And this is also a related trade with the macroeconomics that's going on in the US, right? Because if let's say the interest rate falls, okay, if the Federal Reserve decided, oh, I think the banking crisis cannot take it, let's cut the rates, the USD will weaken. In fact, the USD has already weakened because of the banking crisis, right? Same thing. Let me give you a narrative, right? So, for example, it's not so much about the low interest rate. Okay, that is only if they lower the interest rate. Okay, when Fed lowers the interest rate. Okay, so Fed hasn't lowered this, but if they lower this, will be a possibility. It discourages US dollars deposit, and people want to withdraw, right, and convert to other currencies. Then that causes selling pressure on the US dollar, thereby weakening it. But now it's more of this. Okay, point number 2. Is that the confidence in the financial system, right, is wavering now because of the banking crisis that's going on. And some investors who are scared, okay, or some depositors who are scared will withdraw their money or sell off their stock investments. And they may not even buy bonds, they shift to alternate currencies. We are talking about it could be possibly gold, it can be silver, it can be crypto. That is why this alternative currency has been moving up in the past few days, right? Like Bitcoin has jumped up like 19% in 5 days. So it is quite alarming, right? So it seems like there are enough people that are worried or concerned about this financial system. They want to get out of it, and that is to get out of a USD position, right? So when you get out of USD position, they dump the US dollar to the market, and that's why the USD weakened. Okay, so dollar index actually dropped almost 2% in the last few days. For a currency to drop 2% in a few days is quite a big thing, right? So how do you play this, right? So one way is that we talk about one alternative currency is gold, and gold move opposite to US dollar, okay? Because it's always seen as a alternative, right? So if there is a lack of confidence in US dollar, if our US dollar weakens, the gold prices will go up. So it's an inverse relationship. So one way, of course, you can short US dollar, or you can buy a bear US dollar ETF. The other way is you long gold or silver, right? So these are the alternatives. So one way is to buy this gold US dollar ETF. This is the largest ETF for gold in the world. And this is the Singapore ticker, right? It's a feeder to the main ETF in the US, right? Either one is the same. It's backed by physical gold bullion. And usually for ETF, it's more suitable for smaller investors, right? Let's say you don't want to commit, because let's say you buy one gold bar, I don't know the exact price, probably about what, $50,000-$60,000 per kilo. Okay, so some may feel that that's too much gold for my portfolio. I don't want to buy so much gold, right? Because usually people will buy gold also won't buy a significant amount. Okay, so it's always a fraction of the entire portfolio exposure, but having some is good, right? As a insurance, okay, against the financial system. And ETF definitely makes it easier to size your position, right? Rather than buying the actual gold bar. And the gold bar also require more self-storage, and it might be more expensive. Okay, for example, you put in a bank, but the problem is that the bank is not even people who went to buy gold are not trusting the bank so much anymore. So unlikely that they will store in the bank, and then you need to get a safe or whatever, get fire insurance, all this kind of thing will add up to the cost of ownership. But the ETF will take care of everything, right? They will just store all the gold in the vaults. They have economies of scale, and it's also liquid. Because if you buy a physical gold bar, the spread is larger, the bid-ask spread is larger, right? So you buy, your price is much higher, and you sell, the price is much lower, okay? Because the middleman will have to earn that spread. And liquidity is not so high, right? You need to find someone who's willing to give you a good price for your gold, okay, when you want to sell it. But for ETF, there's no problem. Anytime the market is trading, you can just submit your order. And if the price is fair within a tight spread, you should be able to get filled. Okay, so there is a lot of advantage holding the gold ETF rather than physical gold. So this is what happened, right? Since the banking crisis started, the gold price have shot up 4% already. Okay, so we can see that this is a flight to alternative currencies, okay, gold, silver, cryptocurrencies, okay, and selling US dollar. So that is the trend. And how long will it be? We don't know, right? But it seems like the issue is not going away anytime soon. And if Federal Reserve cut interest rate, then US dollar would will drop, and then gold prices will go up again. Okay, so it might be longer than what we think it is, at least probably a few months. So in summary, as I share with you, ETFs are the best for trend investing. We talk about 4 trends today: climate change, electric vehicles, Fed pivot, weakening US dollar, and there's at least one ETF for every trend. Right, so for the climate change, I talk about the Lion-OCBC Securities Singapore Low Carbon ETF. And EV, I talk about the Nikko AMSTC, MSCI China EV and Future Mobility ETF. For Fed pivot, I talk about the ABF Singapore Bond Index Fund, and the weakening USD, I talk about the Gold US ETF. Okay, so these are for you to consider. Of course, please do your homework, please do your due diligence. Don't just take this as financial advice. Okay, I'm just giving you information. I'm just giving you my views. At the end of the day, you still have to digest and make the best of the decision yourself. So now let me answer some questions. I do see some questions coming in. Thank you, Farouk. Okay, do you think US stock will recover fast after this crisis? It really depends on how bad this event spiral into, right? Of course, I will always suggest that do not exit the market too impulsively. Okay, I don't think it's that bad, especially if you have a longer term horizon. I don't think you should liquidate. And if you want to, you see some stocks that are interesting after they got beaten down to a good price, you want to buy. I would also think that that's a prudent decision. Just provided that you take a longer term view lah. If you are saying that you are trying to trade the market in the next few days, next few weeks, then I would not be able to give you an answer, right? Because right now the situation is unfolding, right? Nobody knows where it can go, right? If the crisis drag for a few more weeks, then it will be quite serious. The chance of US recovery will be longer. If let's say just within this week the crisis is like more or less settled, people are not afraid of the bank runs anymore, then I think the US market might rally, okay, especially if Federal Reserve say, okay, we're not going to raise rates. So that will cause the market to celebrate, man. Right? So that's why I say in the short term, it's very hard to tell, right? But in the longer term, I think that there might be opportunities. Okay. Pastopia asks, I thought banks will now be allowed to borrow essentially unlimited amounts from the Fed, which reduces the risk for further contagion. In a way, yes, they definitely need to step in, and definitely the government will want to save the banks, will want to restore confidence in the system, because that is the only thing that matters. If there's no confidence, there's then nothing to talk about. And the issue is that why are the bank stocks still dropping? Okay, one of the key things that I think is that depositors are safe, but that doesn't mean shareholders are safe. The shareholders of Silicon Valley Bank is getting nothing. It's nothing. The HSBC bought the UK arm for just £1. Okay. £1 share among how many shareholders, right? It's as good as nothing. So if it's nothing, then you think about shareholders of other banks, because most people will still think that other banks will fail, right? Not just the two of them, right? The third one could be the First Republic, okay, and more to come. And every shareholder of other banks are panicking now. They would dump the shares. If I were them, I also would dump the shares, because we really don't know, right? We really don't know whether um we will the bank shareholders will get back anything or not. Okay, so it's better to just dump, right? And that caused the spiraling down of the share prices. Okay, so it is not just the depositors that are worried, but the investors, the shareholders are even more worried, and the bondholders as well. Don't talk about shareholders. Bondholders are also not going to get back anything. Right? So you never know about the OTC market. I didn't check lah, right? The over-the-counter bond market, I think is also in a chaos right now. Okay, probably the bonds are sold off cents for the dollars. Okay, so which means that this crisis will take a while to resolve itself. Right? At least fastest, I think, this week, okay, to restore some confidence, right? Especially maybe 10 days lah, given that the Federal Reserve is going to have a meeting in 10 days time. Okay, so I really do hope that things will get better, right? Just it's very important to be positive as an investor, okay? Because especially your investing horizon is like the next 10, 20 years. you should not be you should not be like having a knee-jerk reaction to just something that's going to last maybe a few weeks or a few months. All right. So if let's say touch wood, really the bank fail, right? The system fail, right? It doesn't matter anyway. All of us are going to get hit one way or another. Okay. So don't be a pessimist. Yeah, be an optimist. All right. I think that's all. I don't see any more questions. And thank you very much for listening to me. I hope it was useful for you. Hopefully, it gives you a better idea what's going on in the markets and some ideas to act on. And of course, just a reminder, this is not advice. You have to make your own investment decision. I can only provide you the information. So I don't know your context. You have to decide for yourself. Thank you very much and good night. Hello，很好，是只有4分钟。 刚刚好，因为还有两个问题，所以刚刚好，不然就早晚了。好，4月1号对吗？这是那个新交所的 event 呢。嗯这个星期应该可以给你了。嗯，可以啊。OK，好，谢谢你，拜拜。